All right, Chapter 13, Retirement and Deferred Compensation. Now, some of this is going to sound familiar. Hopefully some of this is something you guys are already doing. So hopefully it's just going to be more of a matter of how does it affect me and how did I not realize it affects the tax return. Sometimes we get in a little bit of a rut in the standpoint that we know what a 401k is or we know what a Roth is. We don't necessarily know what a 403b is or a SEP account is, and those are some that might walk in the door if we were doing someone's taxes. So some of the different objectives. The main thing that I want to make sure everybody knows about when we leave here, and it seems simple, but it was one of the big things that I needed to know, and I do believe that is a big thing on the exam that you want to make sure you know, is the difference between the Roth and the 401k. All right. Some of you guys might already know it, and you'd be like, well, I already got that. That's great. Others don't, and you want to make sure you understand the difference between the two. The other is the difference between a deferred compensation plan, the employee and the employer's perspective. All right, so we'll look at those, and we're also going to look at something called the Savers Credit, which in VITA was very common that some of our tax people, I don't know what to call them, but some of the people that came in to get their taxes done did get what's called the Savers Credit, which is when you have a certain level of income, usually under a certain threshold, you're working and you're still putting money into a retirement account, you get what's called a Savers Credit. So first of all, qualified plans. To qualify as a qualified plan, you cannot discriminate. All right, that means what you offer to me, what you offer to Leonard, what you offer to Anna, has to be offered to everybody. Your top level executives get the same plan as your bottom level employees. So a qualified plan has to be everybody. There's two different types. There's the defined benefit plan, and then there's the defined contribution plan. Okay, so we'll look at both those. All right. Defined benefit usually fixates on a fixed formula. It's set up ahead of time, and you know going into it what you're going to be set up. It's based on average compensation, typically, years of service, and usually there's a maximum benefit allowed. Like in 2015, the maximum benefit is $210,000. The employers deduct the liability as they contribute to the plan. There are certain funding requirements that are based on actuary numbers, and the employer, not the employee, bears the risk of this. So an example of this would be more like a pension. So for example, my husband works at Schnucks on the warehouse side. He's a Teamster, and he gets a pension. Now, he can also contribute to a 401k, which he does, and we'll talk about that in a couple slides. But his pension is funded through the Teamsters. Right? He does not contribute to that. That is part of the negotiations, or whatever you want to call it, in which the salary that they make is X amount based on them contributing into this pension. Some jobs come with pensions, some jobs do not come with pensions. Right? Pensions usually are under this defined benefit plan in which employees contribute X amount based on your compensation, based on your years of service, and that bears the risk of the employer contributing that money. Now, the employee can also contribute, and we'll talk about that as well. There are vesting schedules when you have that. I remember when I went to work for Mallinckrodt, now I was a salaried employer, I was not a union person, and there was a pension. I didn't even know I had a pension until I was laid off. And so I was like, oh, I have a pension. And there was a 5-year vesting period. So it just depends. Sometimes it's a 5-year, what they call cliff, or it's a 7-year gradual. All right, just depends. Distribution from these are taxable when we get them. So, for example, my husband will be taxed on his as ordinary income when he retires. I got taxed on mine from Mallinckrodt when I received it when I was laid off. So not only did I get taxed on the ordinary income, and it was like $5,000. I hadn't worked there very long. But everyone got vested. That was one of the parts of being laid off. When the company got bought out, everybody was vested. So you got that 5 years of service even if you'd only worked there 2. So everybody was vested. It was taxed as ordinary income, but because it was an early distribution, I also paid a 10% penalty. There weren't a lot of options except for me rolling it into something else, which I did not take at that time. The gradual plan that you can have is under a defined benefit, this 5-year cliff and 7-year graded plan is on page 13.4, and we're going to use it in this example here in just a second. So CBA provides a defined benefit plan to its employers, and under the plan, the employees earn a benefit equal to 2% for every year of service. This is based on their average salary of their 3 highest years. All right? CBA implements a 7-year graded vesting period as part of this plan. So if Tina works for CBA for 4 years, earning a salary of 60, 65, 70, and 75, and then leaves, what would be her benefit? Now, here's the benefit, I've used the word benefit a lot, of the 7-year graded. If it would have been a 5-year cliff and she left after 4 years, would she get any of the pension? No. All right? So that is something to think about when you look for employers, if you go to a company that has a pension plan. And that's part of what you're going to consider as compensation. If it is a 5-year cliff and you're there for 4 years, you just lost your pension. And it can be in a 401k too if they're matching it, which we'll talk about in just a little bit. But because this was a 7-year graded, she's going to get some of it. So first of all, it is a highest 3-year average. So we're going to take 65, 70, and 75. So the average is 70. All right. And then it's 2% for every year of service for the 3 highest years. So she was there 4 years. So 2% times 4 is 8%. So $70,000 times 8% means her full benefit would have been $5,600. That's how much she would have made for those 4 years. However, 4 years of service on the 7-year graded scale, which is on page 13.4, like I said, you go 4 years of service, graded scale is 40%. On the 5-year cliff, if you were to look at it, it says 0. You had to get to 5 years in order to get anything. So 40% of that means that she's actually going to get $22.40. She's going to forfeit the $33,660 because she hadn't been there long enough to get it. It doesn't matter that she was there 4 out of 7 years, and that's not 40%. They go on this other scale called the graded 7-year graded scale. So when she leaves, she'll take $22.40. Now this is another way to look at it. While she was considering that pension as part of her compensation, she did not contribute to any of that pension. And she knew up front that if she didn't stay there, she was going to get a portion of it. That's part of the defined benefit. It's not contribution, defined benefit. She didn't contribute any of her own money to this plan. Now let's look at that compared to defined contribution plans. This is an employee specifies upfront contributions on our behalf, on the employee behalf. So employers typically match our contributions. So let me give you a different example of an employer kind of defined contribution. I work for the state, so even though I work for the college, I work for the state because it's a state-run institution. So we participate in something called PSRS, which I think stands for Public School Retirement something S system. So I am required to put in 14.5% of my salary. All right, but the state matches 14.5% of my salary. So every year I'm saving 29% of my salary, which is wonderful and hard. Now, I don't get Social Security anymore. Now, I will get some Social Security because I paid into Social Security for 14 years. But I will not get very much because I don't pay into Social Security anymore. Since I started teaching, you don't pay into Social Security. So instead of paying 6.2 and my employer paying 6.2, so 12.4, I now do 29. Now, I don't have a problem with it, but there are a lot of people that argue that for teachers that are starting off, young teachers that are making at the very low end of the teaching scale, to be paying in 14.5%, which I think is going to go up to 15, is very hard. And that's been an argument to stop this. I, from the accounting tax perspective, say the more you force somebody to save for retirement, the better. And I don't see anything wrong with it. I think you got to do it. I think you got to. You go in there with your first job and you save 15% right off the bat, you don't know you were even making it. Because most of the people that start making that $25,000 to $30,000 were only making 10 to 15 before. So they're not going to miss that 15%. Now, if you start making $30,000 and then try to start saving 15%, that's hard. That's very hard to do. So that's where, so that's our example. So with the employer matches what we match. Now, most places don't require. It depends. That's what I have, and it's a state thing. But a lot of places, like when I worked at AT&T, they matched what you put in up to a certain percent. So if I put 4% into my 401k, they matched 4%. And they went up to a certain limit. They didn't keep going, but they went up to a certain limit. They may choose how they want to invest in that plan. I do get to choose how I want to invest. Right? And so I get to put my investments where I want. And since Enron, they can no longer make you put even your money into whatever they want. Whereas Enron, before Enron happened, they were making their employees put their own money into Enron stock, which you can no longer make an employee put their money into anything. So alternatives to employer's plan are 401k, 403b, and 457s. So there are some annual contribution limits. All right, $18,000 if you're not 50 years old, $24,000 if you are 50 years old. Make sure, okay. And then employer plus employee contribution limits is $53,000 or 100% of your compensation. So you cannot take whatever you're putting in plus whatever your employer is putting in and have it actually be more than what you're making. Now that seems like a great problem to have, but I think our example walks through that. So Dave retires at the end of this year, and he contributes to his company-sponsored CBA 401k. CBA matches their employee contributions on a 2-for-1, which is a very nice basis, up to 4%. And so, like I said, you will find a lot of companies match, but they're going to stop at a percentage like that. Dave is 72 years old at the end of the year, and he earns a salary of $450,000. Yes. Dave contributed $24,000 to his 401k. How much could CBA contribute? Now, we can calculate what CBA could contribute, and then we could calculate what CBA would contribute, because those are two different numbers. Because based on that $24,000, Dave's going to max out. So the answer is going to be $35,000 because Dave is 50. All right, so his max is $59,000. All right, so 59 minus what Dave already put in, 24. Without any limitations, we would take the $450,000 times the 4% times 2, and it would have been $36,000. But they can't put in 36, they can put in 35, and that's the most. So Dave's account can actually be putting in $59,000 a year. And that's through his employer company plan. It does not mean that someone making $450,000 isn't saving more than $59,000 a year. It just means that's all that he can put in through his company plan. Okay, now vesting. When you vest on a defined, you vest immediately. The reason you vest immediately on what you put in is because it's your money. So if you put your money in and you want to take your money out, you can. Now, it might be tax implications, but you can take it out. You can take 100% of your money out. The employer contributions are different. They have a different vesting scale, and that scale is on page 13.7. And there's a 3-year cliff and a 6-year graded. So basically, you either work for them for 3 years and get 100%, or it's 6 years graded, and it starts in year 2 at 20%, and it's 20, 40, 60, 80, 100. So it's just going to depend on the company and the contribution. Both the companies I worked at that did this plan, AT&T and Mallinckrodt, they did a 3-year. All right, they didn't do the 20, 40, 60, 80. I don't know if this is the more common from that aspect, but I know that when I was at AT&T, they matched, I believe it was 80% of a dollar up until 4 or 6%, which was very good. My dad worked for General Dynamics, which was a arm of the government. I say it like that because they made tanks. Okay, you only make tanks for one person. All right, the government, and they actually matched a dollar for a dollar. I have never seen that example of a $2 for every dollar, but I'm sure it exists. It exists out there in companies that have very nice benefit plans, but that also was a very highly paid employee. All right, now remember, defined, if it's a qualified plan, it has to be for everybody. It cannot discriminate. There's the vesting scale for the 3-year and the 6-year. And then distributions. Again, distributions are ordinary. Distributions from any retirement plan, and these are all retirement plans, are ordinary income. The biggest thing that people don't get is the penalty. And this is what happens. Their financial advisors don't tell them. What their financial advisors tell them are 2 things. 1, you're going to have to pay tax. That's true. Depending on how they put their money in, they're going to have to pay some tax. And then they say, talk to your tax person. Well, a lot of people don't have a tax person. So then they say something like, well, what do you mean? Well, you're going to have to pay taxes on this because you're taking it out. But what they don't tell them is they have to pay taxes on it, and they're going to have to pay a penalty for taking it out early. And I don't know why there's such that disconnect, or if it's the people that are taking their money out choose not to hear that extra part. But I have done at least 3 or 4 friends over the past 10 years that have taken money out and they have been nailed. Because the other aspect is when you take money out of your 401k, and let's say you're taking it out to either make home improvements or pay off bills. Both people that have taken it out took out large sums, like $50,000. What happened to their tax bracket? They went up in the tax bracket. Most of them were in the 15, the lower tax bracket, because they were under like 110. Now they jumped. What else did they lose? They lost child tax credits on 1 or both kids. They were phased out of it. They lost education credits, and they usually lost dependent care credit. So they lost anywhere from $2,000 to $8,000 in credits, depending on if they had the education credit. Then they paid taxes, which sometimes they had that covered. All right, sometimes they took out enough taxes, and then they paid a 10% penalty. When you take out $50,000, what's your 10% penalty? $5,000. All right, so you're paying $5,000, plus you just lost $8,000 in taxes, plus you went up a tax bracket. That doesn't usually make for a very happy person. And they're saying, and you know what their response is? But I took taxes out. Look, I took out $50,000, and they took $10,000 in taxes out. I'm like, yes, that's 20%, but you're now in the 24% tax bracket, and you just lost $8,000 or $4,000 or $5,000 in tax credits, and you got to pay a 5% penalty. None of that was on there. And they don't understand it. And then they're really upset. Not at you, but you're the one that feels bad, for telling them. Okay, so assume that Lisa is 57 years old and she's employed by CBA, and she requests a $60,000 distribution from her 401k. What amount of tax and penalty is she required to pay if she's in the 33% tax bracket? I don't know why everybody in this book makes a lot of money. But every example, have you guys noticed that? Good Lord. I mean, I'm not saying they make 150. Everybody's making like $250,000 to $500,000 in every one of these examples. All right, so what are we going to do? $60,000. Well, here's the easy question. She's 57. How old do you have to be not to pay a penalty? 59 and a half if you're still working. There are some exceptions if you're not working. So what's her penalty? $6,000. Then in order to figure out her taxes, 60,000 times 33% plus that wonderful amount, she is paying $19,800 in taxes. All right, a third. Now, it's not a third without the $6,000 amount. So what she probably had taken out of her taxes, when she cashed this in, my guess is her financial advisor told her to maybe take 28% out. Unless he knew her tax bracket. If he knew her tax bracket, then maybe he was smart enough to take 33% out. I'm not ditching financial planners. That's not what I'm doing. But most of them don't know the tax bracket of the people that they work with. So the chances of them knowing that she's in the 33 tax bracket is not good. And I can guarantee you she didn't know it. Because most people don't know what tax bracket they're in, if they even know what the tax brackets are. So that's why I said 28%. That is a standard fallback, 28 or 36. So if she made a lot of money, he might have taken 36 out. So if he took out 36, then she's in good shape. If he took out 28, she's not going to be very happy. Now there's also something called, this one got me. When I first started doing this and started seeing people take out retirement all the time, it's called RMD. And that's how it shows up if you're being asked on a software, it's going to start RMD. RMD is required minimum distributions, and it's something that you have to take once you hit 70 and a half, or when you retire. So if you're working and you're 70 and a half, you still have to take these distributions. So basically they're saying, it's great you're working, but you got to start taking some money out of your account. So for the year in which you reach 70 and a half, or when you retire, if it's later than 70 and a half, I just said that backwards earlier, I'm sorry, or if it's later. So if you're 70 and a half and you're working, you don't have to take it. Yes, okay. And then each subsequent year. So even still, after I do it, I still say it wrong. So you may defer the first distribution until April 1st of the next year. So if, for example, my dad his birthday's in February. So he's turned 70 and a half a while ago. But in that year that he did it, he could have deferred instead of taking it in, let's say it was this year, 2015, he could wait to take his distribution until April 1st of 2016. Right, so you can push it off of the year until that April 1st. But notice, April 1st is will show up on the tax return. And he still has to make another one in that same calendar year. So he's going to have two distributions. Right? And then it's based on a certain percentage of the prior year, and there's a 50% penalty of any undistributed portion that should have been distributed out. So 70 and a half, or when the person retires, if it's later. Nothing. There we go. Oh, assume Dave retires from CBA, and he is 2015 and he's 72. Assume that his balance in his 401k is $3.5 million. What is the amount of minimum distribution he must receive, and what age must he receive it? Now, this example is in a little bit more detail on page 13-9. And the reason I point to it is because I think they need to give more detail than what they're going to show us when I show you the answer. So when we're looking at 13.8 and 13.9, or 13, I'm sorry, 9, first of all, what is the date that he has to take a distribution by? If he turned 72 at the end of 2015, when did he turn 70 and a half? In 2013. But does it matter? No, he was working. So when does he have to take his first distribution? Now that he's retiring. By what date? April 1st of 2016. Now, assuming that when Dave retires, he has $3.5 million in his account, how much will he have to take as a distribution? There is a set amount. And this is what's not given to you right here. You need to use the table that's on page 13-9. It's an abbreviated table from the, it's actually a financial table. But if you look at Exhibit 13-3, it gives you the age of the participant, and then it tells you the distribution period, and then it says the applicable percentage. So he is going to actually be 3.91. He is 72, so he's going to have to multiply 3.5 million times 0.0391. And when he does that, I don't know why this one requires so many steps. He's actually going to get $136,850. Yes.
So on the RMD, is that based on each individual account, or is that based on the accumulation of all retirement accounts?
That is based on that 3.5 million.
Yeah.
That's his individual account.
So is that number, when it's calculated, is it based on your overall retirement
Yes.
portfolio?
Yes. For that company, for that account. So let's say you had $3.5 million with, what's the name of this company? CBA. Let's say you had another 401k that we're going to talk about once we get through this, an individual 401k, and let's say you had $200,000 in that. You would also maybe have to take a required minimum distribution from that, and that would be another calculation. Okay, so they'd be two separate calculations. Because how your distributions work is every account is going to distribute by themselves, so therefore the calculations are going to be based on themselves. That's a good question. Right, so everyone's going to be by himself. And when you use a software you go through, they're actually going to ask you, if it's a good software and not the IRS's software, it's going to ask you, did it require you to take an RMD? Right? Tax-wise, which is the IRS's software, will not ask you that. And like I mentioned to you guys before, there's a plus and a minus. You know, you go work for a CPA firm, and you will not have a software that asks you a whole bunch of questions, which is wonderful, because I hate software that asks me a whole bunch of questions. But on the flip side, when you're first starting to do taxes or you come across something new, having it ask you a whole bunch of questions is actually kind of nice. So it's kind of a catch-22 on where you're at when you're doing taxes. But even at Reuben Brown, when it asked no questions, you went in there, and if you were a new tax preparer, you could easily miss things, because if you didn't know to do it, it wasn't going to jump out at you and say, oops, you forgot to enter property tax. You just didn't enter the property tax. That's where you had a review. So that's why software that's done at home and for small businesses has so many more checks and balances, because in a large firm, you're supposed to have somebody else review your taxes before they go out. When you're doing them at home, or some of these small firms that these other software packages I believe are designed for, you may not have that same review, so the software package is kind of your review, your step-by-step. That's kind of the way I look at it. Still irritating when I ask you a lot of questions, but still. That's what it's there for. All right, so then it actually says on the next step, it's in the book, it's not on the screen. Assuming Dave's 401k balance had a different balance, and the next year on December 31st, it's now $3.7 million. So he contributed to it more. What is the minimum distribution that it must have received sometime during 2016, in addition to the $136,850 that he already took? So in that case, you're now in the second year. So you're now 73, because it's 2016, so he's now a year older. So you would go to 73, and now the ratio is 4.05%. So you would take 4.05 times 3.7 million, because his amount went up. So the minimum distribution, not only does the percentage change, but if the dollar amount goes up, then his distribution amount is going to change too. So required minimum distribution does not necessarily stay the same. You got to look at it and make sure it's not being updated. All right, on page 1311 is a side-by-side comparison of defined benefit plans and defined contribution plans. I think this is a great page to mark. And even if you get through the homework without any big issues, especially those of you that are considering doing taxes or the CPA exam, I think it's great to understand the difference between the two because a lot of people don't. A lot of people do not understand the difference between the two. And actually, now that you sit there and you listen to what we just talked about, defined benefit, it's given to you. It's a benefit. Defined contribution, you're putting your own money into it. So some of it kind of makes sense, but it's the details that go on below about what the other factors are that a lot of people don't understand. So that's just a good page to have marked. All right, so moving on. So a traditional 401k. A traditional 401k are what most of us, if you've put money into a 401 or into retirement, it's gone in usually to a traditional 401k, meaning that your money goes in before it's ever been taxed. And for the longest time, this was the main way of saving money. Let's put it in now when we're being taxed what we think is the highest we're going to be taxed at. Like that guy making $450,000 a year. He's in the highest tax bracket he's probably going to be in. So let's not pay taxes on it now. Let's pay taxes on it when we take it out. Right? Contributions are before tax, and then the tax, it could be tax deductible. Contributions can be possibly tax deductible. Distributions are the same as in other contribution plans. The 401k, Roth 401k plans are made with after-tax dollars. So the difference here is you get your paycheck, it's been taxed, then you take your money, and then you put it in a 401k. It's called a Roth 401k. These came about, and now I'm going to say it's probably been 15 years. I remember when I was saying 5 years, and I remember when I was saying 10 years. Now I'm going to say it's probably been 15 years since the big Roth boom. They're not tax deductible, all right? And employer contributions must go into a 401k that is traditional. So your employer contributions cannot go in a Roth because your employer contributions are tax-free. So they have to go into a traditional 401k. So a Roth is a qualified plan. You have to have it open for 5 years, and you have to take it, any distributions have to be after 59 and a half. So 5 years and then after 59 and a half. Non-qualified distributions are those that you take before you're 59 and a half and before you've been open for 5 years. That is probably the biggest thing that I've seen people with their Roth is they've opened it and then they want their money back 3 years later. And I'm like, okay, well that wasn't really smart on two accounts. All right, it wasn't a smart investment for a retirement because you wanted it back 2 years later, and you put it in a Roth, right? Which is a double whammy because you shouldn't have put it in there. So they're taxable and they're going to be subject to that fee. So distributions are not distributions from the contributions are not taxable, and they're divided into equal distributions for contributions. Non-qualified plans for deferred compensation. Did I miss a slide? No. Okay. Now, deferred compensation means money that we have not gotten yet, right? Money that is coming at a later date. So deferred compensation for non-qualified plans, so this is still the same thing. This is 401ks, this is Roth, money that was pushed off into the future. Non-qualified plans can discriminate. I can tell Anna that I'm going to give her a retirement package that I am not going to give Leonard. If it's a non-qualified plan, I can do that. And that is what is done at some upper level. All right? They get retirement plans that the lower level employees do not get. They're generally provided to high executives and highly compensated individuals. They can be used to make employees whole when their when contributions to qualified plans would be limited because they have to stop. What did we say? Is $59,000 was the most you could put in? All right. These are they're deemed investment choices, and the risk is on the employee. All right. So they're electing to defer their salary to later. They're basing that salary then on the market and deferred compensation. So instead of taking $100,000 today, you're willing to take a deferred compensation plan in 5 years. Is that good or is that bad? Now, we haven't done a ton with deferred compensation, but if you follow any type of sports, or if you do any type of, like with movies and actresses, sometimes they're given options for salary where they are paid a base amount and then they might get a percentage of how well the movie does. All right, is that risky? Yeah. So that, I'm making numbers up because you know they make way too much money. But they're given $1 million to do the movie. And then they get 10% of the gross revenues. Or they give it $10 million to the movie and no percent. Which ones do you take? Athletes are the same way. I'll give you $10 million salary, or I'll give you a $2 million salary, and I'll give you a $500,000 bonus for, or $10,000 bonus for every yard you run over 1,000 yards in rushing, or something like that. Or for every home run you hit over whatever. Or for a pitcher, for every strike you throw over. And then they got to decide, because obviously that deferred compensation is going to take them far and above their regular compensation. But the risk is going to be, can they get to that mark? What is the risk? The risk is the movie is going to be horrible, right? Or, what is the name of the movie that just came out? And I can't even remember who's in it, but it's based on a family that goes on a vacation down in one of the South American countries, and terrorists take over their hotel. It has some big actors in it, but it just got released, and it's horrible release time. They were talking about it because of what just happened in Italy. Like, the timing couldn't have been worse. And they're wondering what it's going to do to their profits. God, I can't think of what it is. It actually looked like a decent movie. And it's called like Jump or something because they're trying to escape the hotel they're in because they're just innocent people. Yes, it is. That is Owen Wilson, because he's in a serious movie, and that's not normal. Right. And I think it was supposed to be a decent movie, like for him, but they're saying the timing is not very good timing because of how it relates. No escape. There you go. No escape. Jump. No escape. Very close. Or an athlete, what's his risk? They get injured. Exactly. Now, does the team want him to get injured? Absolutely not. They actually want him to do well, because even though they're going to pay him more, if he does as well as they're hoping he does, they're actually going to get other benefits from him doing that well. So, but if the risk is deferred, and the risk is on the employee when they defer salary. The employer deducts for tax purposes when they pay. Remember, now that was auditing class, sorry. But in auditing class, I did a little quick review. I'm not going to do that in here, but if you have any questions, I'll be happy to answer them. In financial accounting, for those that did not take it or took it a while ago, you recognize revenue when you earn it. All right, you recognize revenue when it is earned. So, an employer deducts for tax purposes when it is paid, because that's when the employee earns it, and you recognize expenses when they are incurred, and salary is an expense, so you don't recognize it until it actually happens. So if it's a deferred compensation, you don't get to recognize it until you actually pay it. Employee includes an income when they receive it. So Marshall Faulk, he did have some incentive-based. I don't have any idea what they were, but I do know that he had some incentive-based in his contract when he played. He would recognize it when he earned it, not when he made the deal. And if it's paid after retirement, then the limitations do not apply. The Section 162 limitations don't apply. So what things do they got to think about? Well, both the employee and the employer need to think about tax rates, both the current tax rates and the future tax rates. Okay, right now, the tax rates are 30%, 33%, and 36%. Well, if we're talking deferred compensation for a year, it's probably not that big a deal. Are we talking deferred compensation for 5 years? That's a bigger deal. There's been some athletes that have put off their bonuses in order to allow them to sign other players. Okay, how long did they put them off for? All right, what's the cost, the employer's cost of the capital or the discounted rate? And then what's the employee's cost of that capital or discounted rate? So let's look at a problem before we now. So where this takes us to now is that was the work managed plans. So let's look at an example of work managed plans, and then we're going to look at, okay, now work does that amount. Now what can we do on our own, and how do those affect our taxes?